Hello students, welcome to today's lecture. I'll be taking you through Echo 202, Introduction to Macroeconomics, study session 4, titled Investments and Economic Activities. Outline of study session 4, learning outcome for study session 4. When you have studied this session, you should be able to explain the term investment, highlight different types of investment, discuss the factors that determine investment, discuss propensity to consume and propensity to save. In the previous study session, we have discussed about consumption and saving. Individual household income will either be spent on consumption or saved for future purpose. If otherwise it is not spent or saved, it must be invested. Choices about how much to invest must always be made in the face of uncertainty, as firms cannot know what the market place has in store. Investment is a gamble. Firms that make the gamble hope for a profitable payoff. Meaning of investment. Investment is the act of producing goods that are not for immediate consumption, i.e., capital goods such as inventory and residential housing. In other words, investment is a mindful act of an individual or any entity that involves deployment of money in securities or assets issued by any financial institution with a view to obtain the target returns over a specified period of time. Types of investments. This diagram is showing the various types of investments. Let's start with autonomous investment. This is a type of investment that does not change with the level of income. That is, an increase in income has no effect on investment. It is also referred to as government investment. Autonomous investment remains constant irrespective of income level. This is an exogenously determined investment. That is, I is equal to IO. Another one is induced investment. This is an investment that changes with the change in the income level. Induced investment is positively related to the income level. That is, at high levels of income, entrepreneurs are induced to invest more and vice versa. Another one is financial investment. This is an investment made in buying financial instruments such as new bonds, new shares, new security, etc. However, the money used for purchasing existing financial instruments such as old bonds, old shares, etc. cannot be considered as financial investments. Real investment. This is an investment made in new plants and equipment, construction of public utilities like schools, roads, railways, etc. Increased employment, production, economic growth of the nation depend on investment in real investment. Gross investment. This is an investment that has to do with the total amount of money spent for creation of new capital assets like plants and machinery, factory, buildings, etc. Another types of investment is what we call net investment. This is defined as a gross investment that occurs in an economy less capital consumption allowance depreciation. I believe you still remember depreciation in our previous study session. Let's now go to another types of investment, which is planned investment. This is an investment made with a plan in several sectors of the economy with specific objectives. Planned investment can be called an intended investment because when investor makes investment, he makes on a concrete plan of his investment. And lastly, unplanned investment. This is an investment made without any planning. In an unplanned type of investment, investors make investment randomly without any concrete plans. Hence, it can also be called unintended investment. Determinants of investment. These are the various determinants of investment. Let's start with level of income. Your level of income will be largely determined by how much surplus income you have each month and after paying bills and setting aside a bit of cash for emergency. The greater your surplus income, the higher your potential level of investment. Another determinant of investment is economy. The economy affects everyone and it can affect your level of investment. During tough economic times, household incomes may drop due to economy related layoffs or cutbacks, resulting in decrease in the fund available for investment and vice versa. Risk tolerance. Not everyone has the same level of risk tolerance. Risk tolerance in the sense that everybody with different level of risk tolerance. Some people are conservative while others are more aggressive in how they invest their fund. This also affect investments. Another determinant of investment in future needs. Whether your future plans involve a new car or retirement to a house in a rich people residential area like Lekki, addressing your future financial needs today allows you to plan for those moments. The more funds your future plans require, the higher your investment level needs to be now to reach that goal. Another determinant of investment is what we call expected return. As your risk level increases, so does the expected return of your portfolio, although expected return does not necessarily equal the return you actually achieve, and vice versa. Another determinant of investment is what we call business climate. In the view of business investors, if the climate perceived hostile, no matter how low the lending rate, that is cost of funds, investment level may not appreciate. Another determinant of investment is what we call technical progress or technological changes. The high rate of technological progress, the more profitable it becomes to undertake more investment in order to produce new type of goods by using new and more economical production techniques. Let's now go to propensity to consume and save. Propensity to consume is a proportion of total income or an increase in income that consumers tend to spend on goods and services rather than to save. The ratio of total consumption to total income is known as average propensity to consume. An increase in consumption caused by addition to income divided by that increase in income is known as marginal propensity to consume, because households divide their income between consumption expenditure and saving. The sum of propensity to consume and the propensity to save will always equal 1. This is the equation for average propensity to consume, which is consumption divided by income. Average propensity to save, APS. This is the proportion of a given income saved by the populace. It can be defined as the ratio of saving to income level. That is, APS is equal to savings divided by your income. And another one is marginal propensity to consume, MPC. Marginal propensity to consume is defined as the ratio of change in consumption to change in income that necessitated it. And this is the formula for calculating MPC. MPC is equal to change in consumption over change in income. And marginal propensity to save. Marginal propensity to save is the ratio of change in savings and change in income that necessitated it. It is the fraction or increase in income that is saved. MPC is calculated as change in savings over change in income. Thanks for listening. Hope you enjoyed the lecture. See you in another class. Have a wonderful day. Bye.